Kia ora, ngā mihi nui kia koutou, and ruranga mai, no mai, hari mai, whakatau mai, ki tēnei hui mariko. Ko Barry Koutsaho, ko te kaiarahi o te patea whaiwhakaro. Reira, tēnā koutou, tēnā tātou katoa. Tihei Māori ora. So a very warm welcome to you all. I'm Barry Coates. I'm CEO for the charity Mindful Money. You find information about Mindful Money come up on the chat. We're basically a service for people to find transparency around what's in their KiwiSaver fund or retail investment, but we're also a source of information and research on ethical and impact investing. And we have a role in advocacy around trying to shift money towards positive impact. So we run these online seminars to educate the public and also to engage with the finance sector. And one of the ways we engage is via our annual awards process. And so this year's awards, which are for 8 categories, they include financial advice. And this year we were pleased to have, for the first time, and this is the 3rd year we're doing awards, for the first time, we have co-winners of their Financial Advice Award for the most ethical financial advice. And today we're talking to the co-winners of these, and I'll introduce them in a second. So these seminars are available on Mindful Money's website, on YouTube and other good websites. So please look back through past episodes. There are podcasts there as well, and many people find them a really invaluable source of interesting information, perspectives around issues of sustainability with regard to investment. So today's topic is really about how ethics and sustainability can be integrated into the financial advice process. And I first want to introduce one of the co-winners. Loud applause, please. Peter Lee. So just to introduce Peter, he founded Ethical Investing NZ in late 2014 after many years in the corporate world. His previous roles include CEO of the Institute of Financial Advisors, and he was head of advice support at ANZ Wealth. With a highly personal ongoing advice based on ethical investing, the firm, Ethical Investing NZ, now has 7 staff, and in 2020 became the first NZ advisory business to gain certification from the Responsible Investment Association of Aotearoa, RIA. So, Peter, a very warm welcome to you.
Thanks, Barry. Yes, good to talk to you all. I think the key thing I've learned in my time is that it is a journey, and I've certainly found it over about 20-odd years. Some of that goes back to probably 22, 23 years ago when I started working with Roger Spiller, who is very much the founder and guru of ethical investing in New Zealand, helping him put together some of his first ethical financial plans when there's virtually no products available. So it was that mix and that. And the reason I mention that is that essentially what we have to say to clients is that there's no such thing as a perfect mix, there's no such thing as perfect investments, but anything we do for them, it's almost certainly going to be better than what they're currently doing. And typically we'll say that to clients, say, we can't give you perfection. Here's what we're doing now. This time next year it'll be better. Is that a good basis to work on? And generally speaking, they say now, 20 years ago, 10 years ago, that's fine. The other thing, I guess, is that really ethical investing is part of a bigger picture, which Barry said is around sustainability. Your worldview as people, as advisors, what your clients do. So for me personally, firm, it's a strong thing for us. Walking the talk, being sustainable. And clients see that when they come into our offices, for example. It's not an add-on, it's a fundamental reason why we exist.
So, and Peter, obviously you've progressively kind of integrated these issues more over time. Were there any particular kind of trigger moments for you that really kind of helped you make progress? Anything in particular that kind of helped you overcome any barriers? Anything you can
Well, I
point
think
to?
it's been a change in how people generally see the world. I think one of the big changes was the KiwiSaver issues that came up a few years ago, highlighting is you are a key part of illustrating the issues of funds. Clients realising that these things were available. But it's also a change from people thinking it was about avoiding nasty, whether it's tobacco or whatever, to actually thinking we want to make the world a better place. And that change that we've seen, that's a more positive story and more positive message, and it gets clients more engaged. They see they're part of the future. It's not just avoiding the past.
Okay. Peter, if I'm about to introduce Carey, while I'm introducing her, your sound quality has deteriorated a little bit. If you wouldn't mind closing down any other applications you've got open, might improve. So let me pass to Carey, and Carey, a very warm welcome to you for joining us, and this is by no means the first time you've been on the Mindful Money series, so we're very glad to have you back.
Thank you, Barry.
Carey's been a financial advisor Carey's been a financial advisor for over 27 years. You don't look that old, Carey. Working with her three colleagues. And Carey mentioned to give a shout out to the in-house robot Millie at Moneyworks. Using their unique ethical investment analysis, Moneyworks have supplemented the financial planning services that clients engage their advisors for with a strong ethical investment overlay. So, Carey, also a question for you to kick off. Can you tell us about the pathway that you've taken to integrate sustainability and ethics into Moneyworks' approach?
Absolutely. Thank you, Barry. The business that is now called Moneyworks was set up in 1997, and the very first person who was not family or friends that came to us asked us about ethical advice, asked us about responsible, sustainable investing. In 1997, it was just impossible. There was nothing available. So while we talked to her, we were sort of aware that there were people who were interested in this. When KiwiSaver was launched in 2007, it was really exciting because there was actually a provider who had an ethical offering. At that time, that provider was named Astron. It's gone through various different iterations, and it's now the Booster socially responsible investment option. But that was quite exciting to be able to have that. And at that time, we had a number of clients that indicated to us that that was something that they wanted to do. They wanted their investments to reflect their values. Over the next 10 years after KiwiSaver was launched, we were aware that there was demand and interest in this area. And in 2018, we started looking at it more seriously. The main trigger for us was actually demand from clients. We had clients asking us for these kinds of investments. And we found in 2019 in particular, just about every new client that had come to us was asking us about this. COVID gave us a really good push to do this, as we discovered that there were more investment managers that were actually having real products available in this area, but more particularly in 2020, we discovered Mindful Money. So one of the issues for us for calling ourselves an ethical investment advisor was that we didn't want to be in the situation where we were making recommendations to clients only to find out that there was something hidden in the background that wasn't at all ethical. Having access, so partnering with Mindful Money has enabled us to build our internal proprietary ethical investment analysis, which shows clients personally for them what nasties they have. That led to a whole education program for us as advisors and rolling out ethical investment analysis to all of our clients that we work one-on-one with during 2022. So since 2018, it's sort of been quite a committed journey. And for new clients, that is our offering. We only offer a hybrid or an ethical portfolio, but it's very much who we are. As part of this, we decided to become a B Corp, a benefit corporation, which is a business that is not only in business for making profit for shareholders, but also for our clients, our employees, our community, and the environment. We did that a year ago in August 2022. And one of the things that we all love about it is that ethical investing and being a B Corp really represents our personal values.
Yeah, cool. So let's bring Peter back in. So welcome back on screen, Peter. And let's have a discussion about the key issues. Now, I've done my level 5 qualifications, but I'm not a registered financial advisor. But a few things stick with me, and one of the things from the code of conduct that really sticks is know your client. And it seems to me to be a really kind of great starting point for the financial advice process. Peter, can you talk about the kind of entry process that you have with new clients and maybe an ongoing process with existing clients on the know your client process, and particularly how that relates to values and sustainability?
Sure. I think one of the key things we do at the very start is to basically ask our clients what's important to you, who's important to you, what do you want to achieve, and essentially the conversation around avoiding things like favouring investments is part of that overall thing. And that generally comes through in that asking questions, noting what potential clients say, and then going back. So it's really at the very start of the process to find out what it is they're actually wanting to achieve. The money side, in terms of how much they've got and so on, is really follows second. Because until we actually know what the client really wants to achieve, we're not really going to be able to help them. Ongoing, it's like most advisors will meet with clients regularly, once a year or maybe more often. And again, that's part of what's changing for you. And in part, it's also us letting them know what's changing in the ethical investing world that might be important to them. And we're seeing that particularly now with a much wider range of products around the impact area, for example, which is a great reason to talk to clients about things that simply weren't available prior. So it's a bit of a dance. It's an ongoing journey that we go through as well as our clients.
And Peter, Carey referred to the fact that a lot of the clients who come to her are raising proactively the kind of ethical and values issues up front as part of initial conversations. Do you find that, or do you find that you kind of have to prompt clients through questionnaires or through an interview process?
Probably both. I mean, name's a bit of an advantage. Really, when someone comes to us, they get an idea of how we're likely to be thinking and talking. But we use a questionnaire. We use the REA one as a guide, which is partly around what clients want to avoid, but more and more the focus is on what do you want to support, what do you want to favour. And we get clients to sort of rate things in terms of which ones are important and what would be your top 2 or 3. So it's really a combination of both.
Yeah. And for you, Carey, what are the particular features of your know your client process that you'd like to highlight to make sure that the perspectives come out around values and sustainability?
Couple of things, really. Very similar to what Peter has said. We need to know our clients. But for us, we spend quite a bit of time on the client's history, where they've come from, what their life has been, what their interactions with their family is, and who they are. And that then leads on to their goals and objectives, because it's just, we believe, and I think Peter would say the same, it's just not possible to give people financial advice unless you know where they want to go and how, and help them have a plan of how to get there. But the other thing that we've found really interesting is that we actually use the Mindful Money Nasties criteria instead of the RARE questionnaire, basically because we can quantify it through our process. And when we work with our clients, we ask them how they feel about the different 6 categories, having the different 6 categories in their, having exposure to it. And what we've actually found is that a number of our clients actually know a lot more about certain things than we do. So we have clients who might be very passionate about a volunteer project, like we have clients involved in Amnesty who know an awful lot of depth about human rights issues. We also have clients who in their work are very, very involved, engineer clients who are very involved in renewable energy. So we actually learn a lot from our clients rather than just telling our clients. It's a two-way thing. It's a two-way relationship. So what we have found is that we know our clients way better now that we have introduced another layer rather than just looking at performance to our investment process. It strengthens our client relationships significantly.
Cool. So on that issue of what's available, because both of you have referred to the fact that there's now many more funds available for those interested in ethical investing. What are some of the particular features of what you think is available now, but also where some of the gaps are? What do you kind of, you feel like there's things that clients can now do that they couldn't do before, or gaps where you're not finding product that will meet clients' needs? Peter, do you want to kick off on that?
I think the first cab of the rank has really been equity of shared type products. Overseas was really the start, and we started to see some funds in New Zealand. The big issue, of course, we've got in New Zealand is a small pool of, call them investable companies, where there's enough trading and liquidity for a fund to operate. If I go back a bit, the way we work is to use managed funds. We don't actually use direct equity investments or securities, so we're very much reliant on what managed funds are available. So we've actually seen that order come through. Then, probably more recently, we've seen some of the bond funds start to look more at some of these ethical issues, though it's probably fair to say that it's not as clear-cut with a lot of the bond funds and the securities they invest in to actually show a client this is a sustainable ethical bond fund. One of the big issues that we currently have is around infrastructure, because of the fact that you can have investments in, I don't know, oil and gas transportation as an example, which would sit poorly with a lot of our clients. Yet infrastructure is obviously a key part of many portfolios. But probably the biggest gap we've had really has been around impact investing and the sheer lack of anything that's been available for clients to invest in until very recently. You know, like Carey, we have a number of clients who are, you can call them deep moving. They really favour a particular area and want to make a positive difference. And yet there's not really much that we could offer them, and certainly not as a big part of their portfolio that would be appropriate. But that is changing.
Yeah. And what about you, Carey? I know that you have a pretty good line of sight over Australian unit trusts and foreign funds, as well as New Zealand funds, and obviously there's kind of a greater range of funds that you're able to direct people towards. What do you think of the kind of the areas where there's been progress or not enough progress yet?
One of the really exciting things is that since October last year, we have seen, I can't actually count how many, a number of Australian fund managers launching New Zealand tax and currency PI versions of their funds. What that means is that we don't actually have a currency risk in investing our clients, because when you use an Australian fund, you've always got the New Zealand Australian differential. But a number of these fund managers are actually offering ethical solutions, which has been really exciting. And that's actually enabled us to have a purer ethical portfolio than even a year ago, which alludes to what Peter was saying when he was saying that the environment is continually changing. In terms of bond funds, I do agree it hasn't been a focus of fund managers in the past, but we spend a lot of time and effort communicating with our fund managers, asking what they're doing, asking what they're changing, and we're pretty happy with the exposure that we have to our bond managers now. In terms of the real gap that we have, just moving on from Peter's comments about impact, because impact is like 50 of these seminars, what we are looking at adding, hopefully by the end of next year, is for our big clients and for our aggressive clients, is a small exposure to private equity. Now, the reason for that is that over the last 13 years, probably since the global financial crisis, a lot of businesses no longer listed. It is actually owned by private equity companies, and only concentrating on the listed companies restricts the kinds of companies that you can necessarily have exposure to. So we're looking at a number of private equity funds at the moment. There's one that we like, but we've got to do all our due diligence. And again, it's only suitable for our big and aggressive clients. It's because the problem with private equity is that because it's not listed, it's not continually valued from minute to minute like listed shares, and you have liquidity issues. So you actually have up to 3 months before you can get your money out, and it is very much a long-term investment. So that's the gap for us, but there are actually some really interesting looking solutions becoming available from Australia.
Yeah. I mean, this is, as you say, this is a topic that we've talked a lot about on the seminar series. It's our awards events are about impact investing as well as ethical investing. And in our annual surveys, we're seeing a big kick up in the number of people who are interested in exploring this area of investing with a positive impact. So, and actually Mindful Money's got a project with fund managers to explore how more impact investment can come into mainstream funds. So do you see this kind of looking forward as being one of the areas in your practices where increasingly people are going to be coming to you and not only saying, hey, we want to invest ethically, but actually quite directly saying we want a portion of our portfolio in impact, or we want an impact orientation across all of our portfolio? How do you see that evolving? Maybe you first, Peter.
Okay.
Yeah, totally agree. We're already seeing that now, and it's part of that trend that moves away from negative screens, avoiding stuff, to positively favouring things. And we're certainly picking up that increasingly clients see that as, I want to be able to identify specific areas where my money is making a difference, and it's a measurable difference, and it's oftentimes quite a narrow focus as well. And so we're definitely seeing a yearning demand for more on that. One of the issues is it's not just about availability of suitable avenues. It's actually reining in our clients, because in the end we still have to follow good investment principles, be diversified, provide liquidity, and so on. So squaring that particular circle really means that balance between a core portfolio and maybe a satellite portfolio, and having clients understand that, we've still got to make it financially sustainable for them. It's not just about putting all their money into a relatively illiquid investment, no matter how emotionally appealing it might be, but in terms of helping them manage their behaviour and understanding the trade-offs if they go down particular routes.
Yeah.
That's
Carey?
interesting because it's almost the complete opposite of what I was going to say. So I think that's possibly because your brand name is Ethical Investing and ours is Moneyworks. So Moneyworks has very much, in the 26 and a half years we've been in existence, we've focused on the financial planning side of things, getting people to and through retirement. And that is the core of the work that we do with people. And that is still the main reason that people come to us, is to understand what they have to do to have enough money to retire, and when they retire, to work out how to use that money. So that financial planning and talking about them and their lives really makes up the bulk of our conversation with our clients every year and on an ongoing basis. We don't have clients asking us about impact investing, but that's also because we have educated our clients significantly over the last 3 years. If we start teaching them more about it, then they will probably ask us more about it. But at the moment, our clients are very much learning about ethical investing. And when people come to us, I think we've only had one person come to us that was adamant that they didn't want any exposure to farms or agriculture. But in general, people just want to know their money's not doing bad and it is doing good at that stage. So our businesses are obviously at different stages, and we obviously have different clients. I mean, our average client age is 60. So we work with people from 40 to 65 to get them ready for retirement. And then when they stick around, because we've got clients we've been working with for 26 years, now our oldest client is like 84. So we have quite a different business profile to a number of investment advisors. I don't know how different that is to ethical investing, but ethical investing to our clients is part of their financial planning.
I'd actually agree with you, Carey. I think that's pretty much a lot of our clients, that in the end, two problems we're solving is if they're pre-retired, is when can I start working and have a good lifestyle retirement. And if they are already retired, it's making sure the money doesn't run out.
Yeah.
So, yeah, I totally agree. That's the fundamental reason why they reach out in the first place. And I guess why clients might choose both of our firms is because they want that extra dimension. They want to make sure the money's invested ethically.
Yeah.
And so to both of you, most clients who are going to come and see you do want to invest ethically, but they also want to do so without sacrificing financial return. What's your conversation with them about the evidence of returns, what they can expect in terms of financial returns from the kind of ethical investing portfolios you're able to put them in, and where's your line? Because most people are used to kind of facing consumer choices where you have to pay a lot more for organic eggs and something that's not. But it's different in investing ethically, isn't it?
So do you want me to go first, Barry?
Yeah.
So it is definitely a question, and it is about the only question that we get from clients, and we really only get it from about 5% of our clients. There is quite a lot of research out there, and we backtest and back model our base model portfolios, which none of our clients actually have because it's all personalized, but we have model portfolios. Every quarter, we back test those and model the historic performance. What we actually found at the end of 2021 was that over the long term, the base portfolio, i.e. with no ethical considerations at all, outperformed, so that's over 10 years, outperformed our hybrid, which is in the middle, and our purely ethical portfolio. Over 5 years, the hybrid portfolio outperformed all the others, and over 3 years, the ethical portfolio outperformed all others. Since Mr. Putin invaded the Ukraine, things have just gone like that, and there's been no consistency, no trend whatsoever, but we're continuing to monitor it quarter by quarter by quarter. One of the reasons, and this is a bit of a tricky thing, one of the reasons that ethical investing has outperformed is because the technology companies fall into the definition of ethical. And to the end of 2021, they've gone like that. From 2021 to the end of 22, they went like that. And now they've started coming back up again. Having said that, a number of our fund managers that we use for the ethical investment portfolio have a limited exposure to those technology companies. So we actually have the evidence that we can give to clients. And from all of the research that we've seen, we are confident that clients will not lose. They may not make a lot extra, but we are confident that they won't lose in comparison to the other portfolios.
Yeah.
We do something similar. We actually have a series of model portfolios which are the basis for all of our clients, even if they might have a satellite on top. We actually use an external research firm to do that, construct them, do the back testing and the modelling or whatever, and we actually use that to compare with their non-screen portfolios, if you might like. So that gives us a sense of what we can show clients. But like Carey, I think not that many of our clients actually specifically ask that question. So when we can, they will typically show them that compared to, say, a non-screen one. We look at REA's annual reports, less so in New Zealand because the history of funds here is obviously less, but we show them in Australia how a screen portfolio, say a balanced fund, will outperform a non-one. The other thing, though, we do say to clients is that you're going to be invested in a smaller number of companies. It's going to have more volatility, more ups and downs. So it might have the same sort of return. But like Carey explaining to clients, when tech stocks do really well, an ethical portfolio will outperform. And as what happened 2 or 3 years ago when basically tech stocks fell out of bed, ethical portfolios outperform. And in reverse with energy stocks. So a big part of us is educating our clients why an ethical portfolio in the short term might actually be quite a lot different to a non-screen portfolio, but here's the reasons why. But always going back to that long term. The other thing we generally say to clients is realistically, the sorts of companies that are in these screen portfolios are likely to be more focused on stakeholders. They're more likely to make better decisions at a governance level. They're more likely to outperform as a result. And that's an anecdotal, intuitive thing that clients seem to get that makes sense.
Yeah. We've done a pretty exhaustive look at some of the international evidence over several decades, and it basically accords with your conclusions to say that, over a long period, I think that the terminology is that investing ethically is, on average, at least as good as a traditional portfolio, skewing on the potentially better end of the spectrum. Mm-hmm. So I think the sort of the conclusion, I guess, is to say you're not sort of likely to, on average, lose out as a result of investing ethically, and you may well perform better.
Can I just add one thing? The world has changed a lot since the start of 2020, and it's changed a lot since Putin invaded Ukraine in March 2022. And it's still changing, and people are still trying to work out how it's changing. But a lot of the changes, despite politicians' rhetoric, a lot of the changes are actually leaning towards things that are ethical investments, like renewable energy, like technology. And the world is actually just changing that way. So from that perspective, again, I certainly don't expect clients to be worse off and probably better off, because those are the investments that are going to create our world going forward.
If anyone's got any questions on that, I'd recommend you see our last week's seminar, which featured a view from the Rocky Mountain Institute, RMI, which is one of the leading international think tanks on energy issues. And they provided absolutely compelling data to say that renewable energy is kind of on an exponential growth curve due to declining costs, due to increased scale and demand. And we're going to see a fundamental disruption in the fossil fuel energy supplies. And it's backed up by a report we recently did. And so I think you're right, Carey. We will see some quite dramatic changes. And I think the climate crisis is really, so much to do with that. And we'll find that, an ethical dimension is one thing, a climate dimension becomes an even more powerful kind of determinant of who does well and who doesn't into future markets. Can I just turn a little bit to the financial advice industry as a whole? And as a personal observation, I would say that ethical investing has been picked up by many parts of the finance industry, the finance services sector more broadly, by individual investors. And perhaps the area that seems to have been most reluctant to pick up the message of ethical investing has been the financial advice sector. Am I wrong in this? Is this a misleading impression? What's your experience of how the financial advice sector as a whole has or hasn't embraced this significant change, which is now represented through, for example, a lot of the fund management sector, but not necessarily the financial advice sector? Is that an inaccurate characterization?
Can I just start off? Oh, sorry.
No, you go, Karen. Sorry.
Can I just start off by saying that the financial industry uses words. It's easy to use words to say that you're an ethical, responsible, sustainable manager. But as we can see through the mindful money analysis, not all of them walk the talk. So it's really easy to use words. So although all these companies are saying that they do it, our research indicates that not that many actually do what they say on the label, but there are really, really good managers that do. In terms of the financial advice industry, since 2010, we have had continual legislative change, absolutely continual change since for anybody who's giving investment advice. And as far as advisors are concerned, I think that's definitely brought fatigue. And the latest changes, with the changes to the licenses that came in on March the 15th, 2023, that's taken a lot of work. So I think once we have had a breather as an industry, that we'll see more people able to actually turn their attention to adding something else to what they're doing. I'm concerned that a number of advisors don't understand the value of this, that they don't understand the value of the relationships with the clients, and that they don't understand how many people are actually really interested in this. So when we started the project of rolling it out to all our membership fee clients nearly 2 years ago now, we thought 15% of our clients would move to having a purely ethical portfolio because they'd talk to us about it. 25% of our clients moved straight to having an ethical portfolio, and there are around another 15% who are moving over a 2 to 3 year time period. We didn't know that these things were important to them. Even though we had 20-year history of talking to them about their goals and objectives every year, we didn't know that these things were important to them. And I think a lot of people hadn't raised it with us because they didn't know that they could actually have investments that reflect their values. So I'm optimistic that as more financial advisors get out of the compliance crunch and the changes in regulations crunch, that we'll see more people coming and doing this. And I know Peter and I will work as hard as we can to help people, get set up in this area and learn how to do it and learn how to help their clients.
I think from my side, something similar to Carey, also a slightly different perspective too. Two things which really come to mind. One is, if you look at how most financial advisors work in New Zealand, there might be one or two person operations, or they might work for the bigger corporate type advisory firms. The 1-2 person firms, as Carey says, have had lots of change to contend with. And they're also thinking to do provide advice on ethical investing is one extra level of learning to do. The bigger firms, it oftentimes comes down to the owners, the CEO, whatever, what they personally believe in. Like any organisation, you take your lead from the top. Now, I can think of more than one mid to large size firm where I know there are 3 or 4 advisors who really get this space, but their colleagues don't. And the business as a whole doesn't support those who are really keen in it. That's the first part. The second part is we're in a highly regulated industry. I refuse to call it a profession because professions are self-regulating. We have the FMA leaning over our shoulders, looking at every decision. I actually think quite a number of advisors are probably paranoid about an extra level of risk that they're taking on, or perceived risk if they go down the space. They might like to, but they don't want to be caned if they haven't got it 100% perfect. Even though we don't need to be perfect, there is that feeling. You go into anything that's new, how might this go pear-shaped for me, sort of thing. So I think that a lot of our colleagues, there's a lot of that fear factor that goes on. It'd be great to have that disappear off and see a lot more people, even if sometimes I think both Carey and I would think it's quite nice to have a small field, but we don't compete with each other. That's the interesting thing. But to actually have more people who are able to support in their work environment and feel confident in terms of dealing with the regulators to actually do more in this space.
Yeah. So thank you both very much. I mean, there's a lot about recent changes in the financial advice sector that is really heartening, and we see it as Mind for Money, not only in the award winners being you guys, but there's some fantastic applicants from others who were finalists this year. And some that weren't finalists. So we're seeing quite a few financial advisory firms on that journey, and so it's really good that you guys have come on to talk about your experience and about the journey, and I hope it encourages others to get going on that journey. As I say, most are somewhere on that journey, so a process of deepening their engagement and learning as you go along. I think we're all learning as we go along, and so thank you for sharing your thoughts. As Carey alluded to, Mindful Money's got some materials and research that can help. Obviously, the Responsible Investment Association of Australasia, we've got some good materials for advisors. Others do, and so hopefully there's plenty of support for advisors who are on that pathway. So thank you again very much to both of you. Congratulations on your awards, which is
thank you, Barry.
Which is great news. And we look forward to many more entries into the awards next year. So thanks. I just wanted to conclude by thanking our listeners, if you're on podcast, or watchers if you're seeing this either on live or on video. Thanks to our sponsors, Alphinity, Medical Assurance Society, Mercer, New Zealand Green Investment Finance. Thanks also to Chapman Tripp, Booster, Harbour Asset Management, and Trustees Executors. And we had contributions from Pathfinder and Pi Funds. So, as I said, this is our 19th of our seminars. So this is a series of 20 seminars. So, it's our penultimate one. And We aren't quite sure when our last seminar is going to be, but it will be announced with fanfare. For those of you who aren't signed up to Mindful Money's mailing list, please do so, and you'll hear news and these kind of events and reports and other things, so please do sign up for that. And we will finish with a bang at some stage coming up very soon to end our seminar series. And sooner or later, than the next couple of months, we'll launch a new series. So please do stay in touch for that. So again, thanks to our panelists today. Thanks to our audience. And please stay active. Please invest mindfully. Ngā mihi nui kia koutou, mā te wā.
Kia ora.
Kia ora.